Sanjeev Prasad, Senior Executive Director and Co-Head at Kotak Institutional Equities, joins us as our market master. He's joining us actually from Mumbai, from the Kotak Global Investors Conference. Good morning, Sanjeev. Good to have you with us. Well, how is this cocktail of poor earnings adding up to an FII investor? Is that why we are seeing this incremental selling coming in?
Yeah, I would think so. Obviously the stocks rallied very hard last year in expectations of reform process ultimately translating into earnings activity picking up towards the end of the year, and also earning numbers picking up. But the macros improved quite a lot, I would say, but it's not translating into the micro or in terms of economic activity or earning numbers picking up as yet. So clearly there was some kind of a disconnect building in between, I would say, the valuations which had gone up to very high levels and earnings which were not really increasing, and I guess people are now recalibrating those expectations. To a large extent, I would say the gap between the valuations and the earnings were probably getting bridged by a combination of an improved macro which came about because of lower oil prices, very stable and benign global environment, very strong liquidity over there. As also expectation reforms. Now suddenly people are starting to questioning all the three things. Oil prices have gone up, which to some extent is negative versus expectations of, let's say, $50 a barrel. Suddenly you're looking at $60 a barrel. So to that extent, the improvement in macro which people had assumed may not be there. Obviously, $60 a barrel is still better than the average of 85 which you will see for the current financial year. The second thing is, obviously now there are chances of US rate increase happening a lot faster than what people had assumed earlier, looking at the data which is coming from the US. And lastly, who knows about the reform process, in the sense the government has intentions to do the right things, but clearly there are challenges in the Indian parliamentary system. The government does not have a majority in the parliament, as we know. So put all that together, the macro is starting to weaken slightly, I would say, but still very stable, and earnings numbers are not coming through. So suddenly we are seeing this big disconnect between valuation and earnings trading in people's faces now, and so obviously the market has to correct to some extent, I would say.
Sanjeev, just how much more you think, Sanjeev? I know it's a tough question, but just the hope of the budget as well that growth will pick up sooner or later will keep the bottom at least protected?
I would think so. See, even in the last note we had written that there will be a small correction, so that's what I am still sticking by. Maybe another 5% to go, I would say. But the problem with this market, it does not really have the support of valuation anymore. So as long as the macro conditions remain favorable, as long as the government continues to do the reform process, people will still give us high valuations compared to what it should be logical just based on the earning numbers. You look at many of the companies now, they're trading at really, I would say, even ridiculous valuation in some cases. Many of the consumer names, industrial names, they're baking in either very aggressive set of earnings assumptions which may not come through, or a very low cost of capital perpetuity, which is also very risky assumption, I would say. So that's where the problem is. Logically this market can correct a lot more, but given the fact that India macro story is still looking good, the long-term story is very intact, the government is doing the right things, people will come in and buy at somewhat lower levels. But having said that, what we need to see is a continuous reform process moving ahead. We have 5 important bills due in the parliament in terms of discussions and passage in the budget session of the parliament. So the outcome of that is going to be very important, because that will let the stage for more investment reforms and eventually investment coming through in the country, which in turn will drive the whole economic activity in the country. So that's going to be very critical.
Sanjeev, hi, morning. Let's discuss some stocks now. What are your views on how to approach L&T? Because clearly most of the analyst fraternity continues to remain a prisoner to their views. So they don't believe that the earnings are as bad as it looks. But the ground reality is that these earnings are pretty poor. How would you approach the stock now?
L&T is largely a play on the Indian investment cycle, which is not taking a bath yet. Even though there are early signs that at least order booking is starting to look good, but it's not really translating into execution revenues as yet. And there's something which we have been warning for some time, that investment activity will take another 2 to 4 quarters to pick up in any meaningful way. The way you look at it is the government is trying to do all the right things in terms of, let's say, land reforms, labor reforms, a more transparent process for allocating resources, a better approval system, and so on and so forth. But all that is yet to translate into sufficient confidence in the private sector to start investment. Now, the second problem is who is going to invest. The big challenge is many of the infrastructure companies in India have very bad balance sheets, very high leverage, so they have to deleverage, so they are not in a position to invest clearly. As of now, the government itself is cutting expenditure quite sharply. In fact, if you look at the government's capital expenditure for the first 9 months, that's down 11% on a YOY basis. Foreign spending still not there till the time you see more confidence in the government's policy. So that's where we are. Who is going to invest is really a big issue. On top of it, the Indian banking system is hiding a lot of NPLs, which is probably going to get washed definitely in the fourth quarter to some extent, and maybe even after that, as some portion of the restructured loans get converted into NPLs. So that is the whole challenge in the infrastructure cycle. We believe that it will turn around at some point in time, but it may still be some time away, and that's where the disconnect is between what valuations or earnings the analysts are willing to ascribe to L&T and what is the ground reality at this point in time.
Do you suspect that at the end of this earnings season or already there are going to be earnings downgrades for the current year, and will there be any upgrades for next year at all?
See, for 2015 there have been a series of continuous cuts since September, I would say, as far as ROE numbers are concerned. At one point in time, around August to October levels, we're looking at about 14% growth for the BSE 30 index for fiscal 2015. That has gone down to 7% now. Obviously, there have been some disappointments in the energy sector where the extent of gas price increase hasn't come through as what we had built in, subsidy sharing, no clarity even now. But, a lot of the domestic cyclical names we had to backtrack on the numbers. If you look at fiscal 2016, we are still building a 16% growth for the BSE 30 index, similar number for the Nifty 50. And I would think that there would be earnings cuts in auto, energy, industrials, metals and mining definitely going forward, just based on whatever assessment I have of ground level activity in the economy. There would be cuts over there.
So you mean you're going for FY15 with a 7% earnings growth?
That's it, absolutely.
Oh.
Look at the numbers this quarter. This quarter is, we had gone in with flat numbers. It's already disappointed to the extent of 2%, even before L&T's numbers got reported. And if you look at this quarter numbers, that has got really supported by NTPC, which had a huge 6 billion rupees, if I remember correctly, of tax credits. Otherwise, the numbers would be even poorer. This quarter numbers will be negative on a YY basis. For the BSE 30 index and for the Nifty 50.
So people warned us that it will go up to 10. I don't know if anybody told me even high single digit. No. But 7 is, a reality check for sure. Actually, now 5 seats have come from Delhi, Leads only. And that's 3 AAP, 1 BJP, 1 Congress. Sanjeev, is this just this week's worry, or is this going to linger on the markets?
No, I don't think this is, anywhere reflecting of the mood in the country. I think people still will focus on economic development and governance, which the BJP has promised and is delivering. I think the people of Delhi have maybe a different view of the world. I don't know. Maybe the AAP has a good connect with the common man over there. Something works. What is the magic formula for AAP? I guess it's some sort of a case study, but it works for AAP, I guess. But I don't think, that this is some sort of referendum against the Modi government or anything like that. I think this government is doing a fantastic job, given the constraints of, as I said, the Indian federal structure, the Indian parliamentary system, and obviously there are constraints over there. So it will take time for all the reforms to percolate in terms of benefits for the economy. Maybe it's still a year away, so I don't think we should get too despondent about it.
So let's talk about something that's more relevant to us then, Sanjeev. What does an average retail investor do now at this point? Because, stocks like L&T, SBI, etc. have come off quite a bit from their highs. Do you go in and buy them, or do you wait for a bit until major events like the budget pan out?
See, the best strategy for any retail investor, and I think it's true for any long-term investor, is, just buy good quality names whenever you get the opportunity. If any good quality company comes off based on, let's say, 1 or 2 quarters of bad numbers or anything like that, I think it's a good opportunity to buy. But don't expect anything will turn around in the next 2 quarters. What people make the mistake is not holding on to stocks for a sufficiently long period of time. And the power of compounding is a very, very powerful thing which somehow people just don't get even now, So I don't know. I mean, the only advice to retail investors would be, buy but stay invested for a sufficient long period of time. That's where you make real good money.
But what is the mix of, say, Nifty stocks or mix of sectors that you would advise now? I mean, would you go near PSU banks at all?
Yeah, I've been very inclined towards private banks for a long time, and I think in the environment which is emerging, the private sector banks will continue to take market share quite significantly away from the public sector banks. There are clearly a huge amount of NPL problems in the public sector banks, and a lot of the restructured loans, I hope that figure does not cross 50%, but I wouldn't be surprised to see as much as 50% of restructured loan book eventually turning into NPLs. I am still very worried about the power, steel and telecom sectors. Nobody even talks about NPL issues these days, and the third quarter numbers have been a rude awakening for the market in that sense. So coming back to the question you raised, I think private banks still look good. They will grow at much faster rates compared to the overall credit and deposit rate in the system. They will take market share definitely from the public sector banks, and something like an HDFC Bank does about 22% ROE. It can compound at 18% for a long time. So those are the companies I would like to own. Yes, I'm paying for it. I know 4 times in a March 16 price to book, but it's a bank which is delivered for a very long period of time. So get into companies or own stocks which will continue to deliver high growth, just based on companies which have high ROE. Obviously, you still need to keep the valuation angle in mind, but if you get these companies based on a general market correction, just go buy them. So I'm still inclined towards private banks. Autos, we have toned down our numbers a little bit, and even our model portfolio, we have cut down the weights a little bit over there, just based on the fact that the volume recovery will take some more time. Consumers, we still have a decent position, and IT has been a big overweight for us in the last, I would say, since the end of December, which has worked very well for us. And the logic at that time was good quality companies trading at pretty much near market multiples. How wrong can you go over there?
So if you just had to give us a one-word answer on what you would do with L&T, would you cut positions there or continue to hold?
I already did that actually last week. I mean, we had 4% weight in the portfolio, reduced to 2. Already did that. The numbers were coming out very weak for just about every industrial company, so it was pretty clear what would happen to L&T also.
Fair enough. Just one number, next year's earnings growth as of now?
Earnings growth, as I said, we are looking at 16%. My senses will drop to about 13-14% by the time, let's say, the fourth quarter of the current year gets over.
All right. Well, a low base may also help. You never know. Thank you very much, Sanjeev. We'll let you go and enjoy your conference. And that's definitely a very rich conference. Yesterday, we were audience to that extraordinarily interesting conversation between Uday Kotak and Deepak Parekh. So more such conversations in store at the Kotak Invest Conference.